Every day we use cash or credit cards for purchasing products or paying for services. So, it's centralized finance. But with the emergence of Web3, we got decentralized finance. What is it? What is the difference with centralized finance? How does it work? What benefits and risks? And what a future of DeFi? Watch the video to find out. Decentralized finance, short DeFi, is an emerging financial technology based on secure distributed ledgers similar to those used by cryptocurrencies. In the US, the Federal Reserve and Securities and Exchange Commission, SEC, define the rules for centralized financial institutions like banks and brokerages, which consumers rely on to access capital and financial services directly. DeFi challenges this centralized financial system by empowering individuals with peer-to-peer digital exchanges. DeFi eliminates the fees that banks and other financial companies charge for using their services. Individuals hold money in a secure digital wallet, can transfer funds in minutes, and anyone with an internet connection can use DeFi. Centralized finance is the default financial environment in which the world currently operates, with payments, loans, and trading activity passing through third parties and middlemen that are heavily supervised by local regulators. Decentralized finance, on the other hand, delivers a whole host of advantages by enabling people to transact through financial applications via a blockchain network, cutting out intermediaries, such as traditional banking groups. Eliminating middlemen naturally cuts costs and speeds things up, but DeFi also makes financial services much more accessible. In the world of centralized finance, not everyone is allowed to open a bank account or be given access to specific financial services. DeFi therefore has the potential to financially empower billions of people around the world who are currently denied access to banking services. DeFi also has the advantage of providing more flexibility, for instance with trading hours not being limited the way they are with centralized finance. DeFi is a technology alternative to relying on centralized financial institutions such as banks, exchanges, and insurance companies. DeFi systems achieve distributed consensus by using smart contracts on blockchains such as Ethereum. Developers write smart contracts to perform specific actions only when certain conditions are met. As a simple example, you could write a smart contract stating that you will pay $500 to another person if the Cardinals win the World Series this year. Once the smart contract is pushed to the blockchain, everyone in the blockchain's network can access and read the code, but no one can change it. Smart contracts are often what govern decentralized apps, or dApps, which are not owned or managed by any one company or person. While Ethereum was the first platform to develop smart contracts, other blockchain platforms use them as well. DeFi enables any two parties to securely and directly transact without involving an intermediary or central authority. The result is that many more people can access financial services at lower costs or receive better interest rates than those offered by traditional financial institutions. Open, you don't need to apply for anything or open an account. You just get access by creating a wallet. Pseudonymous, you don't need to provide your name, email address, or any personal information. Flexible, you can move your assets anywhere at any time, without asking for permission, waiting for long transfers to finish, and paying expensive fees. Fast, interest rates and rewards often update rapidly, as quickly as every 15 seconds, and can be significantly higher than traditional Wall Street. Transparent, everyone involved can see the full set of transactions. Private corporations rarely grant that kind of transparency. DeFi technology is immature and has yet to be fully stress-tested at scale over an extended period. Funds may be lost or put at risk. A lack of consumer protection. DeFi has thrived in the absence of rules and regulations. But this means users often have little or no protection when things go wrong. No state-run reimbursement schemes cover DeFi, and there are no laws enforcing capital reserves for DeFi service providers. Hackers are a threat. While hacking is also a risk in traditional finance, DeFi's extended technological architecture, with multiple points of potential failure, increases the so-called attack surface available to sophisticated hackers. For example, white hat hackers exploited a smart contract vulnerability in August 2021, stealing $610 million from the DeFi platform Poly network. Luckily, all funds were returned. Collateral requirements are high. Nearly all DeFi lending transactions require collateral of at least 100% of the value of the loan, if not more. These requirements vastly restrict eligibility for many types of DeFi loans. Private key requirements. With DeFi and cryptocurrency, users must secure the wallets used to store cryptocurrency assets. This is an important requirement for both individual private investors and institutional investors using multi-signature wallets. Private keys, which are long, unique codes known only to the wallet's owners, used to do this. If a private investor loses their key, for example, they lose access to their funds forever. Crypto platforms let you send digital assets around the world seamlessly. While borrowing and lending are key advantages of DeFi, there are also applications for savings, where you can earn interest on crypto, trading opportunities, fund management, and insurance. DeFi currency exchanges, or DEXs, are peer-to-peer platforms enabling traders to exchange cryptocurrency with one another. Not only do DEXs facilitate direct trading between participants without a middleman, but users can maintain total anonymity. Traders typically have control over their wallets and can access thousands of tokens via their private key. Tied to stable currencies like the US dollar or assets like gold, stablecoins aim to eliminate the elevated volatility associated with many cryptocurrencies. It means stablecoins tend to be better suited for everyday transactions than other highly volatile cryptocurrencies. Stablecoins are easy to transfer around the world, which makes sending large amounts of money more affordable and significantly faster. Stablecoins also allow users to earn interest. Rapidly growing in popularity, DeFi lending allows you to lend digital assets to others while earning interest. Lenders can pool their assets with others, setting terms through smart contracts. Borrowers generally need to post collateral in digital currency to secure a loan. This means that borrowers can, for instance, access funds in a major coin such as Bitcoin, while posting collateral in a more obscure cryptocurrency. If you borrow through DeFi, provided you make the interest payments, you can access Bitcoin without having to sell your collateral. Those who are looking to get started in DeFi should proceed carefully and be sure that they work with a reliable counterparty. Though the yields offered by DeFi are enticing, don't let the potential return blind you to the other risks. A downdraft in cryptocurrency markets could quickly wipe out any small gains from yield farming, and outright scams or theft could wipe out your crypto wealth even faster. Thank you for watching this video. Subscribe to this channel to watch new videos. Be careful with your money and your wallet.